Hello and welcome to episode 479 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, we're back. How are you doing?
I'm good. I'm really excited about the new app. We've mentioned it on the podcast previously. I want to say a big thank you to everybody who's been testing the app. So that has come to a close. You've all sent your feedback. It's incredibly useful and overwhelmingly positive. So we'll be able to tell you more about that in the future. But those of you who did help out, you have been sent a final questionnaire that you need to fill out. It will be really helpful for us about the future direction of the app and also your own experiences. But you'll also be able to claim your free Money to the Masses mug for your hard work. A couple of other bits of admin really, Andy, before we kick on with the podcast. Next week, there won't be a podcast episode. So Andy and I are taking a few days off to spend with our respective families because it is half term. So there won't be a podcast because we won't be around to record it. But we will be back with a bang the following week because a date for your diary, the autumn budget, is happening on the 30th of October. There is inevitably going to be quite a bit that falls out from that. Speculation suggests we're going to have all sorts of changes, perhaps to capital gains tax and inheritance tax. We've done some bits and pieces on our socials and on the podcast about the predictions for the budget. So we will be back with a bang that following week. And those of you who also subscribe to our weekly newsletter, if you don't, why not? If you do, that will be back the following week as well. So we're going to have a bit of a mini break. Then we are going to kick into that post-budget special.
Yeah, so let's get on with what we've got coming up on this week's show then, Damien. A packed show as always. We've got three pieces.
Yeah, so the first piece I'm going to be doing is in relation to mortgage rates. So there's been a surprising change in mortgage rates. So the mortgage market, we had seen mortgage rates falling in recent months because of that cut to the Bank of England base rate that we saw back in August. But in recent weeks, there's been a sudden change in the mortgage market, and we've actually started to see some mortgage rates rising once again, which has spooked everybody and produced a whole wave of headlines in the press. So what is really going on with the mortgage market? Things have changed. I'm going to tell you and explain what's going on beneath the surface. I'm also going to do a piece on gold. So not too long ago, we talked about gold coins, but I've actually been asked the question about the direction of gold itself if you want to invest in it, because the price of gold has just hit another all-time high. So it is now a good time to invest in gold. I'm going to be doing a bit of technical analysis and explaining where the price of gold might head in the future. And the final piece, Andy, is something that's been inspired by your own personal life.
Yeah, I got a surprise water bill come through in the last few weeks, and I've been racking my brains thinking, what's gone wrong? Why has my water bill risen so much? And so I've done something which listeners can also do. And so I've got a little goodie bag that I'm going to reveal on the podcast of all the things that I've ordered for free and received, and what listeners can also do. They're in this bag here. We'll save it for the end of the show.
So if you've not watched the video version of this podcast, you can watch it on YouTube, of course, but also Spotify. Then I suggest you hop over there this week and watch the show, because Andy is going to be showing some things. I'm going to be showing some charts as well in my investing piece. Of course, it will still work as an audio podcast because at the heart of this show, we are an audio podcast, but do go and have a look at the video feed because I think you'll find it interesting to see some of the products that Andy has. So going straight on to the first piece in the podcast, mortgage rates. So as I mentioned in the intro, there's been a significant change in mortgage rates in the last few weeks. It's really happened mostly in the last 10 days. And we started to see headlines suggesting that mortgage rates are starting to go up again. So if you look at the fixed rates out there, we have seen some of them start to creep up, and you will have seen a lot of headlines from the national newspapers saying that rates are going up and spooking people. And I've had lots of emails asking, what is really going on with mortgage rates? Is it true that they are rising? So we're going to do a piece that explains what's going on. So the first thing I'm going to do is show on screen, for those of you who are watching the video version of the podcast, a chart of the overnight swap rates. If you're listening to this, I'll just describe what people are looking at. So overnight swap rates are what the various banks out there will lend to each other at, the rate that they will charge to lend money to each other. And what they really do is give you an insight into where the banks think the Bank of England base rate will be in the future. So you can make a chart of them. Now, if you make the chart at various different times, you will get different lines. So what is on screen at the moment is a chart of the predictions of where the Bank of England base rate would be made at various different times. So there is the prediction going back to December 2023, a prediction from August, one from September, and one from now in October as I make this podcast. And the significant shift that we've seen this year is that the Bank of England base rate would actually fall lower than previously expected, and it didn't actually achieve the height that was expected back in December last year. So we obviously know it peaked at 5.25% and then was cut to 5% in August. But what's happened in the last couple of weeks, the market has shifted where it thinks the base rate will end up. So if you go back to mid-September, the market was predicting that the Bank of England base rate over the longer term would end up just above 3%, around about 3.14% to be precise. But it would get there by the end of 2026, but most of that fall would have been achieved throughout 2025. Well, the market has shifted significantly in the last couple of weeks to the point that it actually thinks that the Bank of England base rate won't get below about 3.6%, maybe 3.55% over the next 5 years. And in fact, it will get down to that level probably by the back end of next year, so the back end of 2025. That's quite a big jump. So what that means is the market is thinking the base rate across the whole time frame will probably be somewhere like 0.25 to 0.5% higher than they had predicted a month ago. So that shift in swap rates has actually fed through to mortgage rates. So it means that banks are now predicting that the base rate will be higher over the longer term, and therefore what we've seen is a number of banks either pull their best fixed rate deals or increase the rate on them. That's not universal. I'm going to go through some details in a minute. So why has that started to happen? Well, there is a nervousness around the rate of inflation. So the price of oil recently picked up. Part of that was because of the geopolitical tensions in the Middle East. And that started to feed through to a fear that inflation might prove stickier than people had previously thought. The other source of uncertainty is the upcoming autumn budget. So the market is worried about what's going to be announced. If you think back to the Liz Truss budget 2 years ago, then the market reacted very badly to that. And that was at that point because of the planned spending that wasn't actually going to be funded in any way. It didn't seem to be at that point. There were no announcements about how things were going to be paid for. That caused the market to become anxious, and we saw mortgage rates rocket. So we're not saying we're in that scenario necessarily, but the market is nervous about what is going to be announced. So we've seen some rates being pulled in terms of fixed rate deals by some lenders, some rates going up, but it's not a universal thing that's going on. And overall, if we look at the mortgage market, since September, we've still seen the average 2-year fixed deal fall by 0.16%, and we've seen the average rate on a 5-year fix fall by 0.13%. Also, the average shelf life of a mortgage. So shelf life means how long the deal is available to consumers. So the lender will pull mortgage deals if they've filled up their quota that they want in terms of customers, or something has fundamentally changed and they no longer want to offer that product. That has now risen to 21 days. It was actually 15 days earlier on in the year. The point is that you have plenty of choice. Deals are around. There is stability in the mortgage market. In addition, we've seen other innovations. For example, Nationwide has announced 6 times loan to income ratios for borrowers on lower incomes than we usually see. And also the 100% LTV track record mortgage. You remember we did that on the podcast previously. It's a mortgage that helps renters to get onto the property ladder. That has actually had a fixed rate that's fallen below 4% for the first time. And that happened in the middle of September, and it still hasn't changed. It's still at that level. So you can see there's plenty of good news in the market. In terms of who did actually pull their deals, well, Santander was the big headline grabber because they had the leading 2-year fixed rate deal. If you had a 60% loan to value, they pulled that deal, but it's since come back to market, and it's only marginally higher than it was a week ago. So we still see 3.89% on a 60% loan to value. That is still a very good rate and it's still market leading. In addition, Coventry Building Society also pulled their deals. So we've seen them come back to market. There's a slight reprice in those, about 0.1% to 0.23% higher. But then on the other hand, we've seen NatWest and Virgin Money cut their rates, as did Clydesdale and Barclays. So it's very mixed and the mortgage market is a little bit up in the air at the moment. What we might see once the budget is out of the way, we could see those swap rates that I mentioned earlier change significantly, because don't forget, we've seen a significant change in the last few weeks. It could go the other way. And of course, they could actually go higher. So we don't really know at the moment, but the headlines are making out that rates are rocketing up. They're not. There's just a bit of a mixed bag. It's more of a reason to go and speak to a mortgage broker to shop around and find you the best deal for your given situation. But it may mean that you have to be a little bit more decisive if you are remortgaging at the moment. So if there's a deal that you like, then you might have to be a little bit more decisive about taking it, because there is this volatility in the mortgage market at the moment. I think just to finish off the piece, which will be useful if I just tell people some of the best rates that are available out there at the moment. If you're watching this on video, the tables are on screen. We do update these tables twice a week. So I'll put a link in the notes for those of you who are just listening to the podcast. You can go and look at it at your own leisure. But at the moment, best 2-year fix is that Santander deal. It's about 3.84% as I make this. If you've got a 80% loan to value, it's 4.39%. And Barclays offer the best 90% loan to value rate at 4.75%. 5-year fixes, you can get 3.74%, 60% loan to value. For 80% loan to value, it's about 4.07%, and a 90% loan to value, it's 4.29%. I'm not going to go on to the 10-year fixes, but I will mention tracker rates because people are probably interested. We've seen 2-year tracker rates fall. They were 4.99%, but they've come down in the last month or so to 4.59%. So that's a 60% loan to value. That's Scottish Building Society. If you're looking at 80% loan to value, it's 4.74%. Furnace Building Society, it's 5.24%, and that's at a 90% loan to value. Now, the market is predicting the Bank of England will cut the base rate in November, and there are some analysts that are starting to think about a potential cut again in the December, because the inflation came in much lower than expected at 1.7%. I think that was yesterday, actually, when that was announced. So the rates that we've seen in the market may start to change in the coming weeks as well to adjust for that. But we've got to get the autumn budget out of the way. One thing to bear in mind, some of the rates that I have mentioned are on offer to new customers or people who are buying a property. So not people who are remortgaging. So the mortgage market is volatile at the moment. It's nothing as frightening as some of the headlines are making out. But if you are remortgaging at the moment, you'll probably need to be a little bit more decisive about what you are going to do. So make sure you do seek advice.
Okay, let's move on to the next piece of the podcast then. We're going to be talking about gold. Now, we talked about gold coins a few weeks ago on the podcast, but Damien, someone got in contact with you to ask about where we're at on the price of gold in general. So we thought we'd bring it to the pod.
Yeah, so the price of gold is something that has hit the news in recent days. It's because it's hit another new all-time high. And so we're pushing around that $2,700 mark. And as anybody who's an 80/20 investor member knows, I invest in gold in my own 50k portfolio. And we've talked about it on the podcast. Typically, I would hold around 5% of my portfolio in gold. If you hold too much more than that, if you get up towards 10% or more, it starts to make your portfolio more volatile, because it is a very volatile asset. Now, I wanted to talk about gold on the podcast because we're at this all-time high. It's performing incredibly well. And there are people who are wondering, well, whether to invest in it now at this point. Now, what I'm really talking about here is obviously investing in things like ETC, so exchange traded commodity funds. And that's what I hold in my portfolio. So I haven't got a crystal ball. I can't tell you whether the price of gold is going to explode higher or collapse from here. But what I can do is look at technical analysis, which is a method of looking at charts. So if you think about the squiggly line that would be the price of gold, and you could use certain mathematical ideas to try and see where lines of support or resistance are. Now, we've talked about technical analysis before on the podcast, but if you don't know what it is, if you think of those squiggly lines, then what happens, there is a human behavior that if something starts to sell off, so we start to see the price of gold fall, it will get to a point where it becomes attractive or more attractive to people, and attractive enough that you'll get a load of investors start to pile in. So if you think at that point, the price of gold then turns around and starts to head higher again as more people buy it. So more people buy it, that increases the demand for it, pushes the price up. So on a chart, you'd see the price bounce higher, and that's partly because of human behavior, but some of it is because of algorithmic trading. So computers will buy in at certain points because they're programmed to do so if they are being controlled by traders who are trying to trade this market. Equally, if we get to the point where the price of an asset gets so high that they start to sell out and take profit, there's not enough people wanting to pile into it at that point, so therefore the price starts to fall. It's that whole supply and demand thing until such point as people are selling out, they're taking profit, they become spooked, and then it gets to a level where people start to buy in again. So those lines of support and resistance are very interesting. They are historical. You can see them going back over time, and you can use them to try and predict where the price is going to go next. Could it fall further or could it rise from where it is now? Think of it like a weather map. It's not guaranteed to tell you whether it's going to rain where you are or at a given moment, but it gives you a steer whether the weather's going to be pretty decent or fairly dismal. So by looking at these things, we can try and predict what's going to happen to the price of gold in the future. Now, for 80/20 investor members, I carried out this for gold and silver. Now, silver is kind of like the more volatile sibling of gold, but I'm only going to focus on gold on the podcast. I'm going to show a couple of charts on screen for those who are watching this podcast, but for the rest of you, I'm going to just describe what's been going on. So last year, I carried out a piece of technical analysis on the price of gold, and it wasn't just support lines and resistance lines. You can see some quirky patterns that do give an indication of bullish or bearish outcome. So the market is either going to go higher or lower. And one of them is the cup and handle formation. Now, it's on screen for those who are watching the podcast, but for those who aren't, if you imagine over a very long time, so we're talking over nearly 2 decades when I drew this chart, you can imagine that the market's gone up and down over time, but there's a general trend that it's peaked, come down before rallying again, and then coming down slightly before rallying again. And if you think about the side profile of a cup with a handle, that's what you kind of got. The big dip, then a smaller dip. That formation can be very bullish and signify that the market is going to break even higher. Now, this time last year, actually a little bit earlier than that, in July last year, I carried out a piece of research that suggested that at that point, the price of gold was somewhere near around, I think it was about $1,700 per ounce, that we could, if the formation did hold and it actually was a sign of bullish intent, that we could get to about 2,500, which was obviously a much higher price than where we were then. Fast forward to today, and we've actually gone past that level. So it was a sign of technical analysis really coming to the fore and actually paying dividends, not literally because gold doesn't, but you know what I mean. So that is an example of where it works really well. Sometimes technical analysis doesn't, but it just gives you a steer. Now, if we look at the shorter time frame, so we're looking at mostly this year, the rally in gold has been fairly relentless. Of course, we've had some minor pullbacks, but it's been very strong, and we've got up to around about $2,700 per ounce. Now, those of you watching can see the chart, but those of you who can't, it has been almost a relentless diagonal line with an occasional pullback. Now, that is very unusual. The strength of this rally has been incredible. Now, why has gold been so popular? Partly, gold is a haven asset. People think it's a hedge against inflation. The evidence of that is fairly flaky, but it's normally seen as a haven asset because it hasn't got many uses in terms of the economy, in terms of it as an industrial metal, unlike silver. So it tends to be an asset that does well when people are scared. Warren Buffett famously made a quote about it, but people tend to buy it when they're worried about things like geopolitics. Well, we are in a very uncertain world at the moment, but gold tends to also do well when the dollar does badly or when interest rates are coming down, because it doesn't actually pay any income. It's just a metal that doesn't provide any kind of dividend or yield. Therefore, in a low interest rate world, it tends to do better. So all of those things have combined to be a very good environment for gold at the moment. And so what you can see is that the price of gold has headed ever higher. We're hitting these continued all-time highs. We've had a minor pullback in sort of the last month, but it's bounced higher again. Now, from a technical analysis point of view, that upward trend line, that channel that I've drawn on the chart. So if you can't see the chart, if you imagine a line joining all the low points of any pullback we've had in recent months, and then an equal line that's parallel to it that joins all the higher points, it gives you a channel, and that channel is upward. And so it's zigzagging all the way up. That is obviously a very strong support for gold. There's a number of support lines on the way up as well. They're usually around the sort of strong 2,300, 2,400, 2,600. So round numbers, they psychologically are quite strong for investors. We are humans after all, we do like round numbers, but there is evidence to show they are strong support lines. The upshot is that gold does seem to be in an uptrend, and it remains in that uptrend. There's a couple of other more nuanced technical signs that you can talk about, things like bull flags. I'm not going to get to in the podcast. Now, there are suggestions that we could see the price of gold head towards 2,800 in the short term and even $3,000. Now, I'm not making that prediction, so don't go out and buy gold based upon that. It could all turn around, especially if we see the dollar spike higher, for example. But with all the uncertainty in the world, and as I mentioned, central banks starting to cut rates, we are seeing a very positive environment for gold, and we might see that continue higher for a period of time. Certainly the technical viewpoint is very positive for the precious metal. So as a roundup on where we are with gold, it's very positive. We've seen all-time highs. It is likely that we could see some more going into the future. So it'll be interesting to follow up on this maybe in a year's time to see what happened to gold and when we did eventually see a pullback if we do by that point. But the precious metal is definitely shining brightly right now.
Okay, so moving on to the final piece of the podcast then, and we're going to be talking about water bills, because in the Leaks household, we've had a bit of an issue because water bills have been going up and up and up. Now, we're on a water meter, and the first thing I did, obviously, is rallied the troops in the household and asked everyone to stop using so much water, think about turning the tap off when they're brushing their teeth, all the usual things you do as family members, tell the girls to stop taking long showers. But that aside, I started to try and have a look and see if there were other ways that we as a family could just save water in general by best practice. And I stumbled across a website, which I'll put on the screen now for viewers who are watching the podcast, but also I'll read out the web address. Now, it's a website called savewatersavemoney.co.uk. And once you visit that website, you put in your postcode, and that will tell the website which water company you've come under and whether you qualify for a certain number of free products. Now, this is where it gets quite exciting, because I did this, and as sad as it is, I was super excited to see that my water company, Southeast Water, allowed me to order a number of free products. And you can see from what I've got on screen, these aren't cheap, simple solutions. These are actual products that if you wanted to buy them yourself would cost you a serious amount of money. You've got shower heads, you've got products you can attach to your kitchen tap to regulate the stream. And I'll cut straight to it, because here in my hand, I've got the delivery that arrived today, which made me super excited. And I thought, well, we can bring this to the podcast now. So I'm going to open these and reveal these. And the first thing I've got is a free shower head. Now, I am excited about this because I was going to buy a shower head anyway, because ours is a few years old now and it's stopped doing what it should do. And a few of the little bits were blocked up. So yeah, look at this, a brand new shower head. Now, this shower head is designed to regulate the stream and why are you laughing, Damien?
Well, the reason I'm laughing, for listeners, why am I laughing? Because I feel like I'm in a QVC advert. So Andy's got his regulated shower head that will reduce, presumably, the amount of water that's being wasted in the shower. So I'm impressed by that. What next have you got in your box of tricks, Andy?
Well, the next thing I've got is a really simple device here. It's a little rubber device, and if ultimately that is a universal plug. You can pop that in any sink and it will ensure that you can plug the sink up. So rather than running water straight down, if you don't have a plug and you don't know where to buy one, You can order one for free, potentially, if your water company allows you to. Let's have a look at what else we've got. Oh, these are quite interesting. So these are buffer loos. Now, the idea here is you fill this up and you pop it in the cistern at the back, and it will displace the water and ultimately reduce the amount of water that your cistern needs to fill up. So this bag is for single flush cisterns with a capacity of 7.5 litres, and when fitted, it will save between 1 to 2 litres per flush. Now, we've got a toilet upstairs and down, so there's 2 of those in the bag. So I'm going to be installing those later today.
So that's instead of the old-fashioned sticking a brick in your cistern. So you've got a modern version of that. Brilliant.
That's exactly right. Yes. So while we're talking of toilets, we'll talk about these. These are leaky loo strips. Now, the idea of this is you place these strips probably overnight, once you've flushed your toilet for the last time for the day, and you leave it on the back of your toilet. And the idea is that it will be able to detect whether your toilet is leaking water from the back without you knowing. It's very hard to detect. And so the stickers themselves will turn a different colour or completely split in half if you've got a particularly bad leak. But looking at the details on this strip, it could save up to £175 a year if you've got a particularly leaky loo. And who knows, I could well have that because my water bill's gone through the roof, as I say. So looking forward to trying out those.
So just for those listening, there's strips that go into the back inside the toilet. So in case the cistern is dripping water all the time down into the bowl, so you can't detect it. So that is a strip that tells you. So Andy will be able to use that and inform us in a future episode whether he in fact has a leaky loo. What's next?
Next, we've got the kitchen stream tap fitting. So I'm going to put that on our tap, and ultimately, again, it regulates the amount of water that comes through and should save you money when you're doing your washing up in the kitchen. Well, that's all I ordered. I didn't want to get too greedy because there are lots of things you can order. Let's see how we get on with those. There was one other extra thing that they popped in there for free, and this is your stop tap tag. You basically put that on your stop tap. So in the event of an emergency, if you're not around or someone is around, they can easily locate that and hopefully stop you from wasting lots of water and potentially your house flooding as well. So that's, I don't know if that's useful. I'll pop it on there.
I think that is brilliant, given that you have ordered that for nothing and got all those devices. And well done to anybody who's listened to the whole part of that podcast and didn't just sit there thinking about the potential pun that Andy Leaks missed on talking about his leaky household, because I struggled throughout that piece without trying to say the pun. But if you put your postcode into that website that Andy mentioned, if your water bill doesn't actually offer these products linked to this service, like mine doesn't, I'm Thames Water. If it doesn't, then what happens? You get pushed through to a website that helps you save water by asking you a series of easy questions about water usage, like how many showers you use, whether you water the garden, etc., etc. And then it comes up with some ideas of how you can cut your water bills in another way. So I think that was fantastic. I think it's a brilliant piece for the podcast. Do try it. There's a whole range of devices you might be able to get, including ones that Andy didn't mention. So the whole range of them on there. So Andy, I think that's it. We're done for this week. Just remember, there won't be a podcast next week. We'll be back with a bang, as we said, when the budget happens. I mean, that is going to be something that's quite significant. We've all got to work that day. Andy wanted to have the day off work. So Andy has had to come in on the budget day. So do think about poor old Andy who wanted to have a day off, and he's had to come in because we've got to do stuff around that for you, the listeners. So do make sure you give us a 5-star review on any podcast app that you use, particularly for Andy's efforts in trying to get this to you and not having a day off with his family. So other than that, do follow us on all our social channels, particularly Instagram, TikTok. I'm doing lots on socials, stuff that doesn't appear on the podcast. Do follow us on our YouTube channel and also join our Facebook group, facebook.com/groups/money to the masses. So I think, Andy, all that's left to say is until next time.
Until next time.